Great. So we'll start off with a few quick ones to get us prepared for the big stories that will come. But maybe we can just talk about which kind of area have you found the most pain in your startup career? Was it raising capital, finding a co-founding team? Was it your family life? What was the biggest the most wars you've had over your startup career?
Yeah, I was gonna say I'm not sure I can differentiate. That's an unusual question to answer, as a matter of fact.
Probably all of the above then.
Yeah, I think I wouldn't throw my family under the bus there. I would say actually the hardest thing was finding balance between family life and startup life. I think that was perhaps on the family front of that. I think everyone would agree capital is almost always the hardest thing to come by, followed closely by talent. I'm not sure that I could differentiate one as being more painful than the other. Although I love finding talent, and nobody loves fundraising, so I can't say that that's a fun thing to do. But yeah, lots of individual stories to tell, but broadly, I'm not sure I can pick between them.
Yeah, and I didn't add customers in there because they can also be painful.
In my case, I would say
Just a little bit higher. I think you turned it up.
thank you. So I guess my biggest challenge is technology. Yes, technology. No, in my experience, it is the raising capital. Of course, it is a challenge. But for me, if I'm choosing the most difficult scenario, is circling back to a founder who thinks his baby is beautiful and having to step back and say, dude, this is not happening like this. And you have, because there's a real human equation there. And so how you handle that is very indicative of the path forward, because there's many branches that could happen right at that moment. It could be a very allergic reaction. It can be, many other, it could be end up in collaboration. And so I think that's for me a high point.
Yeah. And I would say it's the first 12 months where you start to, what I call, break the catch-22. So you start to have a few people to go validate the idea and start to build up, and you need to start growing your team and start to raise capital. It often comes in waves. And then you have to, when you're going to market, your first introduction to the market, people know about big pivots, but I'm a big fan of small pivots or even learning. So when you kind of learn, it's finding out what's adopting and what's not, where are they paying higher price points or not. For sales reps, where are they profitable or not, and do you need to move what market to make sure the sales reps turn profitable. So that first year where you have to figure out, do you got to shift into more bigger end markets? Do you need to do these micro pivots? And kind of basically trying to sit there and have enough step-ups to unlock more capital, enough capital, get the team a little bit bigger, and finesse that process. And really, I say, like, when you're taking a certain initial direction, you're doing micro pivots until you're really dialing in where you're going. And that first year, that whole process is what I find is the most challenging.
Great. Let's bring it back to Court, and I'm glad you didn't want to throw your family under the bus. I think the family can be great support, right? But sometimes there are things that your family might not understand. This is, founder company chaos stuff, and you need other means of support. Who might those be, Court? Other founder peers, your team, investors, your board. Who do you normally go to when things get rough?
Not to my investors. Typically, I'll start with that. I've had great investors. Honestly, I have great relationships with all of my investors over the years, and I pride myself on managing that, but that's not typically where I go. The reason I actually began FounderNexus is that I found that I was the most energized and engaged and the most supported when I was with other founders with similar experience. And that I found it frustrating that I didn't know enough founders. Like, finding us, I'll put myself in this community, finding people like us is hard in the wild, as I call it. You could walk into any room and not know who is a founder of any type. There's no possible way to know that. And so, but when I happened to be in those weird moments where I was surrounded by a bunch of people like you guys, that's when I was like the most energized, the most excited, the most engaged, and the most supported. So the concept of FounderNexus grew out of that realization. So that was sort of where I began.
Awesome. Rob, Brian, anyone else you like to go to?
It's for my experience, it is a combination of three things. At the end of the day, it's consistency, collaboration, and consensus for us. So if you think of those three things as things you're trying to achieve, where does it come from? Is our investors a source? Sometimes they are, sometimes they're not. Again, there's a bell curve there, and then it's also knowing your investors, because there's people that are more suitable than others, let's just say, and so that's part of the selection process. But it is
the team, the investors, like those investors will potentially give you money again, even though it was a failure. That team might join you on the next thing, even though you had a failure with them. So great point there, Brian. Let's go to Rob. Tell us when all the investors pulled money from your fund and what happened.
Yeah. Yes. So not that. Thank you, though. This was more about on an individual company basis. There was a company called, well, I guess I shouldn't necessarily name it, but this was just pre-pandemic, and this was a company that, say the name, LivePass, which had a terrific technology about best prices for live events, and it was right at the right time and the right place with the right people, and then there was that little pandemic thing, and so there were no live events, and so it was absolutely very crushing to the woman who was the founder, and she was terrific, and it was, again, those type of situations where it's not about finding fault, it's about finding a solution. And so in our case, we didn't have very much money in it because it was a seed stage, literally, but it was about to launch, and it was all that excitement, and then a crash like that. And so that's really rough, because it was completely external as opposed to self-inflicted wounds. There are those, but this was not that.
Maybe Rob, you can give a takeaway around not throwing good money after bad. So like, when do you know, like, where did the founders come back and say, hey, we actually just need more money to make this work? And you were like, no, this is done? Or how are you thinking about when it's time to cut the losses?
In a case like that, it was pretty cut and dried. I mean, everyone saw what was happening. It was, you can't swim uphill against a pandemic, and there was no one had an idea what was going to be happening on the other side, and it affected. We'll get to later war stories, but it affected several companies in our portfolio, and interestingly enough, accelerated other ones. So it is very situational, and you have to adapt. You have to be adept, and again, communication, consensus, collaboration.
All right. Well, Court, what do you got for us?
All right, I love telling these
negative,
stories.
The bad war
it's
story,
great.
the painful one.
So this is a real lesson learned story for all founders. So it was my fourth company. All right. So I'd had 2 reasonable successes, 1 giant success, and I was like, cool, I got this. And the company was growing. I had the company going. We had to do at least 1 pivot, but by this point in the story, we were growing 50% a month on a multi-million-dollar run rate. Okay? This company was a rocket ship. And then it died. It exploded catastrophically. And from January of 2018, when I first got the news I'm about to share, I shut the company down 2 months later. Shut it hard. Okay? What happened? The business was built around a primary customer who was growing like a weed. We had facilitated their growth in a way that they were growing like a weed. Okay? And we were a technology supplier. We built a piece of tech that they were licensing from us quite handsomely. Again, multi-million-dollar a year. The founder of our customer, and this was the main customer, right? You have to start somewhere. So we're starting with one customer, and we had several other customers that were starting to adopt, were nowhere near the same adoption level. So these guys were 90% of our revenue, and the other 5 customers we had were the last 10%, okay? So nobody big enough to make a difference. Founder of 90% company goes to an alumni event at his college, ends up sitting next to a 25-year-old kid from Croatia who is the guest, who is the nephew or some cousin of some other graduate of this university. They get to talking over dinner at this alumni event. Turns out this kid had just finished graduate school in Croatia, where he and a handful of other colleagues, grad students, had built a technology effectively identical to the one I was licensing to this guy, and he was willing to basically give it to this guy for free. He didn't know what he had. He had no value to it. He had done it as a grad school project, and the next thing I know, my customer calls me up. He's like, "You're out. He's in. See you later." Doesn't matter. We'll run out the contract. We don't really. We have a license to license your software. We're discontinuing it tomorrow. We're adopting his thing. See you later. Okay? Now, good entrepreneur, I flew to Croatia the next day to meet with this kid, or like the next week, I guess it was. Tried to buy his technology, couldn't work out that deal. And I realized, doesn't matter how well you execute, back to those laws of failure, that random shit happens, and it blew us up. It was just that fast. And it was like, now, what am I happy about? That was a terrible outcome. Everybody lost all their money. The team was so good that to this day, since 2018, every year they get together, we all get together, that they organized it. I get invited, I don't organize. They organize a get-together just to reminisce and hang out. We all stayed in touch, some of whom are still working together. So we went through this horrible experience together, but culturally, it held up. And I'm really proud of that.
Thanks for sharing. That was super specific. I love it. Of course, the end of the company is never happy, but I like how you had a positive takeaway. Let's go to the real positive wins of the war stories. So let's go with Rob. You can take us, start us off. Maybe stop along the way with like the milestones. Like, was there a point in time where you said, you were in this war and you were like, we should just give up, or maybe we won't win, and then after you win, you probably look back, did we really almost give up at that point? Like that one, we were just about across the finish line and we were going to stop. Tell us a little bit about the milestones along the way.
Yeah, I think maybe if I could just twist it a little bit, because there's kind of an interesting one that's live now.
Oh, please.
That we can all play along with or share with, because it involves a merged company that's now public. And so, again, with consideration here that none of you guys can buy this stock now, so thank you very much, at least for a while. In any case, but to be specific to answer your questions, yeah, there are. I mean, for wins, in our fund, we've had eight profitable exits, and the opposite side of the pandemic was one of them was FanDuel, and so that was massively accelerated in the pandemic, because if you're not going to live events, you want to have that same level of activity and connectivity, et cetera. And so that one was dramatically accelerated. And another one was a company called Lemonade, which is a fintech insurance company. So that was one that we were involved in. And it is, there's kind of I'm trying to remember the name of the guy that interviewed Warren Buffett years ago, famous interview, and he's saying, "Well, Warren, how did you become successful in all of these different things? What did you have any commonality? What was the commonality there?" And his answer was, "I always sold too soon." And so that is, let's take Lemonade as a case study. Again, when our experience is we don't want exposure to the public markets. There's a lot of volatility there. There's times when you have to be. But you want to minimize it best you can. And in the case of Lemonade, it went public. It had 2 release periods. We were locked up until release period number one. We sold it, about 42 seconds later at about $60 a share. The X months later, we had our second release period. Within the next couple of days of it, we sold the balance at 122, and we were in the low teens. So it was a success. The stock went up to 180, and we were all getting calls. You can imagine this court. So yeah, how you're idiots. You're blank blank. Like most, I can't repeat. And again, think of the Warren Buffett thing. Because if anyone looked up LMND right now, it'd probably be less than $20 a share. I don't know, 15 something. So that's one of those things where you kind of have to stick to your guns. And if you have a formula that works, that a process, as the court says, and follow the process. And it's no one ever went. The other adage: no one ever went broke taking a profit. And I don't want to hog the mic, but there's this public company now is kind of one of those ebb and flow ones, which is more reality. In our case, it's a merged entity that we had originally tried to merge with another portfolio company of ours. The founder was set on choosing a SPAC versus our solution. Poor choice by him, and that's again a story for another time. The company thrives now, and it's still in the portfolio, but it was not the merger partner we were looking for. We found a plan B that is incredible, fabulous. Merger happened in January. It's all about low cost hydrogen production, so it's clean energy. A lot of our companies are about double bottom line, meaning doing well and doing good. And so in the energy sector, it's about clean energy as opposed to oil out of the ground for us right now. And this is one of those ones where you get these twists and turns. Example is this merger came together. There's a process by which a public company that has no volume becomes more well-known, more known to the market, has a lot more market makers in it, and becomes something that we would all recognize and trade, etc. However, you get these bizarre twists and turns. Example, this company never been late in reporting, and if you're public, there's many reporting requirements, right? So in the world of out of left field, the company that they had been doing their audits with got dinged by the SEC for bad practice. There were 350 clients, one of which was our company, that had to re-audit. So when you become behind in reporting, that's not a good thing when you're trying to bring yourself out to market, right? So there's that. And this is literally going on in real time. Next week, they're supposed to have their re-audit done and get back on with, Google Finance, Yahoo Finance, because they won't report you if you're not current, full stop. And so meanwhile, we'd acquired the technology that was the base for this clean hydrogen production, cost of $100 million. And so a lot of money on the balance sheet, came into the balance sheet. It's terrific, and there's public announcements going on at the same time that you can't find the thing because of the audit scenario. So it is, I'll stop there because there was an announcement 2 days ago about a New York-based investment bank that's now doing an equity raise for these guys. So later on, this will be one of those stories that maybe a month or a couple of months from now, we have 4 months left in our lockup period.
Yeah.
So we'll have this call, have this conversation later.
An ongoing war story. Well, maybe you can just we'll come back to you on just like understanding what a success looks like for you, because I know obviously in that case you want it to come out that there wasn't actually an issue there and there's no financial problems with the new audit, but maybe that's a lesson for like laying the groundwork, like building trust. I know, so I used to be a public markets investor and as a professional public markets investor, and a lot of it was how much do you trust management over time, not at one point in time. So, if it comes out that they have to delay something for some reason, if you were concerned about trust the whole time, you're definitely not going to trust them then. But if, you trusted them the whole time, maybe you'll give them a little bit of leeway on this. So, Bryan, what's your big win? You had a war, you went to battle, and you came out on top?
This was assurance.com. It was an insurance company, and I was CTO on day one on. And it was, it would be a matter of insurance agents. They go on a general script to kind of sell the way they sell. We would systematize that and do AI guidance. And we had our own insurance agents in our offices. Then to get the best talent, we had them work from home, and the software would guide them, drive the phone system, feed them leads, and then the AI would guide them through the script. And as the customer was responding, they'd enter the results, and the script would malleably guide them through the process. So insurance agents are like low-end, like inside sales, very, very expensive to run that business. And then the cost to acquire leads was super capital intensive. So we had this very intense drive to go. It was very, very expensive to operate, and we had to go kind of do that rush to get the efficiency there, and we were able to kind of thread the revenue there. And I would say two critical things is, one, we had to do a biz partnership with insurance company to do the underwriting and the product in the back end. So that partnership was make or break. And then another one is, people probably have heard the story about PayPal. Back when PayPal was growing, fraud was so massive, it killed off their competitors. They were about to die. They effectively created the algorithms to fight fraud, and that saved them, and it also kind of locked out their competitors. So for us, we ended up having this problem with fraud and insurance leads. So there's a whole bunch of online marketing driving to getting lead capture, and there's a whole bunch of fraud in that space. And so we ended up having to fight that fraud with AI, and that would have killed us off. So that was a battle, and coming out the success of winning that AI battle was what made that profitable. And then later we got a $2 billion exits, but it was a matter of that threading very expensive costs and the AI battle, and then getting the partnership were all kind of time critical.
So would you say part of that was just taking a smarter approach? Was it top talent you had hired that got you through it? How is it that you positioned yourself or your company to make sure you came out on top in that situation?
I don't want to give away IP, but going after fraud and having a lot of data and AI can give you some pretty awesome stuff. So it's really a matter of you're really chasing bad guys, bad behavior. They leave trails in the data, and you go use other data. And effectively, when you kind of bought leads, especially leads when they eventually turn off to be fraud in hindsight, you use that as a training cluster, and there's a whole bunch of good stuff. So I'm very optimistic about AI and the fraud space, and that was that. And the other thing was just super capital efficient to just scale the reps, ramping them up at the right layers was also make or break and all that.
Awesome. Well, thank you for sharing. We're going to open up to audience questions. Just a couple. Be respectful of these folks' time. So who has a question? Kathy, go for it. If you have time, we have time.
I'll be brief. So this one actually came from DocuSign. So this was a DocuSign situation where when we brought that product to market, not surprisingly, we had something that was saleable, but we were targeting SMB enterprise clients. Okay, so not individual. We were very deliberate about the fact that we never gave it away for free. If anyone's ever heard me speak, I'm very negative on freemium models, and I can talk about that in the future. But that's a very tough slog to go one-on-one companies. And so, we're getting close to, I was like, oh man, this is not quite working the way we thought. We're getting customers, we're not quite acquiring them quickly enough. The aha moment happened when I was able to land a deal to embed our tool in the National Association of Realtors platform, okay? So, National Association of Realtors is 3 million realtors across the country. Most of them use the software NAR provides, which manages the doc set by state. And by going to them and saying, I tell you what, we're doing this one-on-one, but that, because we'd met with some real estate brokers and agents, we went to the NAR and said, tell you what, if you embed this in your tool that's used by 3 million realtors, we'll cut you a particular kind of deal. And that was that you could white label it except for the signature. Every part of it could feel like it was integrated into your tool set and feel like what is your thing. But when somebody signs on the line, they DocuSigned by Court Lorenzini, all right? DocuSigned by Rob Grenley. That was our branding. What that did was absolutely transformational for the company, okay? We gave them a good deal. They passed that deal along to their realtors. The realtors started using it en masse. All the humans that were buying and selling houses started using it en masse, and the cycle started. That was the kickstart moment, the giant win, because that was the big breakout market for DocuSign initially. And all of a sudden, all the consumers who were buying their homes and selling their homes were like, wow, I have a business. I would love to use it to, finance my car, send my kid to college, do this other debt instrument, any other type of financial instrument other than buying my house. So that was sort of the big win in a short moment.
I'm glad we got to that. One of the incubator companies and founder Joshua will find this useful. We were talking about distribution along a similar lines. So Joshua, you should probably connect with Quarter on this. We'll take one more question. You'll hear from Joshua later as well. Please.
In my experience, not. And the reason is from my vantage point, it's more about a product and or a product and how can you what are the best use cases for it. If you find a home run like that, that's fabulous. And in the case of several of our companies, that's how we have had success, is finding the use case, finding the customer. But it's hard to drive to a specific customer. It's more about driving to where you think the market, the broader market is. What's the total addressable market? You've heard that TAM expression. And then who are the early adopters, right? So as opposed to going after one person, one of the challenges is, as Court said, that if you score a major customer, that's fabulous, but you also need to think about diversifying your customer base, because the day you score them, perhaps you could lose them in the future.
Yeah, 95%.
Right.
Heavily leveraged, and if the NAR had blown up on us, that would have been the end, right? So flip that around to Rob's point.
Yeah, exactly. And so that's in our clean energy company. One of the reasons we acquired the technology there is so we can do other use cases. We can license the technology out. And so I think you think of a TAM, a market that you're attacking, and then who are the early adopters? Who are the people that will follow those people? Who are the people that will be the last guys in?
Thanks, Rob. Brian, you want to have the final word?
Yeah, so I think for a customer acquisition strategy, like one business, it ended up being one area, type of channel that scaled the whole business. And so you normally look for that channel that can scale and be profitable, the two critical things, and then you scale that as much as possible. You might have some other channels that give some lift, but oftentimes one's the backbone. In another company, we had a sales team inside, and then for marketing to sales qualified leads, we found trade shows worked for us to get like $28 leads. We can go get that scale and power our team, and they're really high quality, so they're profitable. And then we had another channel. So we ended up finding out two channels. So the rest of the channels were not profitable. They could, so you couldn't really scale them. But these two, they ended up keeping our sales team busy, and we were able to scale with those two. So you really want to figure out which sales channels can scale and be profitable, and they're your backbone. And you want to ideally grow more, but sometimes you have other ones end up being your background. And then you really want to get as much mileage out of the channels that will scale.
So Court, Rob, Brian, I really appreciate it. It's actually hard to get people to come up and share the painful stuff and all the details. So give these folks a round of applause. Really appreciate it.
Oh,